Hello students, today we are going to talk about chapter 7, internal controls and cash. So the first thing we're going to talk about internal controls. So what internal means here is inside the business. Controls means any policy, procedure that all employees should follow in order to make sure that everything is safe in this business. When we're talking about in this business, everything is safe. If you're talking about assets, assets could be cash, assets could be inventory, asset could be building, automobiles, furniture, fixture, anything that provides future benefits or helps business make more money will be considered an asset, and we are going to safeguard these assets using these controls. So it's a key responsibility of a businessman is control operations. We want to make sure on a day-to-day basis everything is happening the way the business owners likes to happen. So measure, undertaking entire reliability of the accounting data, protect assets, and ensure employees are following policies and procedures. Because what happens when employees do not do that, accidents might happen, errors may be committed. So we want to make sure, and it reduces the likelihoods of errors and catch any error that may occur before they become a big problem. Prevention, that's the most important. Controls are intended to deter a problem before it occurs. Detection controls, the second type of control, to uncover problems after they occur. So prevention is before and detection is after. Prevention is much more desirable than detection, because we want to make sure that bad things will not happen to our employees, assets, and business. Primary way to prevent is detect and correct fraud. What is fraud? Fraud is anything that is intentional. And intentional harm and intentionally not doing the job, these are fraud. So you have your intent in it. In an error, when we are talking about errors, it could, if it is unintentional, it is mostly considered, an error is considered unintentional, or it's simply a mistake. It could be a silly mistake, or it's just a mistake that could happen to anyone. Anybody, we say to err is human. So humans do make mistakes. So so errors and fraud. Errors are unintentional and frauds are intentional. Internal control is an organizational plan, means for the entire business, and it's related measures adopted by an entity. Entity means again business, to safeguard assets. So it's like a homeowner. If you're a homeowner, what you like to install, you want to make sure that you have fire alarms, you have smoke alarms, you have fire extinguishers, you may have security installed, you may have cameras installed around your home. So you want to make sure that your assets besides home and anything inside the house, including the people who are living there, are safe. Internal control is the plan and measure designed to safeguard assets, encourage employees to follow company policy, promote operational efficiency, and ensure accurate, reliable accounting records. So we are recording everything and we are reporting, and what we are reporting is based on good records, so there are no mistakes. And comply with legal requirements. When we're talking about legal requirements, it could be from IRS, it from the state tax authority, it could be OSHA, for employee safety or business safety practices. It could be EPA, Environmental Protection Agency. So all of those things are legal requirements. Establishing clear lines of authority and responsibility. So who's responsible in what scenario? Existence of identified supervisor is a preventive control. Means if something happens incorrectly or you believe something should not happen, you should be able to identify who the responsible party is, means the person who can address this issue. Okay. Knowing somebody is evaluating performance makes it more likely employees will follow established procedures. For example, I assign you assignments, you do your assignment, and I will tell you how the entire class did it. For example, I gave you exam 1. All the class took the exam. I told you that was an average, say 70, median was say 80. So that means half of the class got more than 80. So you supposed to get 75. So you know that you better than average. Average was 70, you scored 75. But again, you know that the upper half or the top half of the class scored 80 or more numbers. So it will give you a sort of a motivation that, hey, I'm standing almost in the middle. So let's see if I could score another 5 or 10 extra points to improve my score in this course. Supervision is also a detective control, because when you provide a supervision, that means an employee knows that if they do not know something or if they discover something, they can talk to someone who's readily available for them. Are likely to discover errors during reviews, and in some cases they review employees' work on a daily basis, and in some cases they are reviewed every month or every 6 months or every year or every quarter. The next is Internal Control and Sarbanes-Oxley Act. So there is a committee of a sponsoring organization, COSO. It provides leadership related enterprise risk management, or ERP, internal control and fraud deterrence. So basically what they are providing, enterprise risk management. So every enterprise or every business has some internal and external risk. So how are we going to manage risk, and how can we use internal control and fraud deterrence to manage the risk? Always remember when it comes to risk, we cannot eliminate risk. We always learn to manage risk. Risk can only be managed. It cannot be always eliminated. Okay. The mission is to develop a framework and guidance to help companies improve their internal controls and reduce fraud in the organization. Fraud at multiple levels, maybe stealing a cash from a cash register is one way of one thing of fraud. And removing inventory without any reason and rhyme and take it at home, it's also a sort of a fraud. Or any other asset that belongs to the enterprise or the entity or the business, it must not be taken without the permission of the business. Public companies are required by US Congress to maintain internal controls. So what happened, public companies are required to go through audit every year and are required to go through an audit of financial statements as well as the audit of the internal controls. So publicly traded companies like Walmart, Target, Bank of America, Pfizer, all of those companies must have an external auditor coming to their business and performing a financial audit as well as performing an internal controls audit. So what is the difference? Difference is all the controls, all the policies, all the procedures according to the business they have designed, implemented, and monitored needs to be reviewed by an external auditor. These external auditor can do both audits, means the financial audit as well as the internal control audit, or the business has a choice to hire two different companies for financial audit and one for internal controls audit. The Sarbanes-Oxley Act was written and passed by the Congress around 2002, and it is because of the accounting scandals such as Enron, WorldCom, and other companies. Okay. What are the provisions of Sarbanes-Oxley? must issue an internal control report, which is a report by management describing its responsibility for the adequacy of internal control over financial reporting. So public companies management is going to issue internal control report just like their financial report. So they're going to give you an internal control report, and they're also going to issue financial statements such as income statement, balance sheet, a statement of retained earning, and a statement of cash flow. And an auditor would come and audit these reports. An auditor must evaluate internal controls. So that is an internal control audit. And there is a public company accounting oversight board, PCAOB, oversees the work of auditors of public companies. So here is PCAOB, monitor and audit the auditors. Here are all the auditors, such as you may have heard KPMG, for example, Deloitte, EY. These are auditor. So PCAOB monitor and audit these auditors, and these auditors monitor and audit public companies such as, audit public companies such as Walmart, Target, and Pfizer, other companies. So accounting firms are not allowed to audit a public company, and provide certain consulting firms for the same client are not allowed to audit and provide certain audit. So either you can audit or you can provide consulting firms. So these companies can either be auditor or consulting firms. They cannot do it both. Before 2002, they used to do both. Components of internal controls are control procedures, risk assessment, information system, monitoring of controls, and environment. So what are control procedures? Built into control environment and information systems, companies gain access to the objectives of internal controls. Examples include proper separation of duties, comparison and other check, adequate records, proper approval, and physical safeguards. For example, what is proper segregation of duties? For example, you as an employee need a new computer. So you would go to your manager. Manager is going to approve your request for a new laptop. Then it will go to the purchasing department. The purchasing manager is going to look a list of all the approved vendors, and they're going to pick 3 vendors. They're going to send an email to those vendors or a letter, and they say, we are looking for a laptop with this specification. What are the prices? The 3 companies are going to submit their quotations. Then among these 3 companies, the 3 quotation based on whatever criteria the company has, they're going to pick one quotation, and then they're going to send a purchase order to that company. The company is going to receive a purchase order. They're going to mail you the computer. The computer is going to come to the warehouse. The warehouse is going to open everything, and they say, okay, we receive a computer with that specification and this purchase order. They're going to contact the manager who ordered it, and they, yes, we did order it, and they will send it to that manager. Manager look at it, then give it to the employee. Once the employee is satisfied, they sign over it, and then all the paperwork is starting from the very beginning will go to the payment department, and the payment department evaluate all the papers, look at everybody has signed it, and then they're going to send a payment to the company that has sent this computer to the manager or to the employee who needs it. So that's how the separation of duties, proper approvals, checks, and records of all of those things. Risk assessment is that company faces risk that company faces offer where mistakes or fraud might happen. So you need to evaluate as a manager what are the places or procedures where risk could happen. A company must be able to identify its business risk as well as establish procedure for dealing with those risks to minimize their impact. Let me give you an example. These days we are talking about electric vehicles, or we are talking about other devices, our computers, our cell phones, and a lot of other devices that we use at home. But all of these devices use certain elements that are not available in the United States, and these are called rare earth metals, and these metals are very expensive. So a lot of people always concerned that we may not be able to get those materials on time to complete our production, and we are sitting and wasting time because of this. So this is a risk. So what we need to do to address this risk? Do we need to find other places where we can get materials, or do we need to find an alternative of these materials? So these are the risks that a company faces. Information system. Information simply means an accounting information system where you enter. So accounting information system, or such as whether you call it a QuickBooks or whether you call SAP, these accounting records related to all accounting information. And so what we talked about in the beginning, a business is all about transactions. A transaction is coming into the business and transactions going out of the business. So what these transactions needs to be recorded. So once we record, there is a high chance we will be able to report correctly on our reports such as income statement and balance sheet. So that's why this is important. And this also keep track of assets and measure profit and losses. Every system within business process accounting data should have the ability to capture transactions as they occur and record, generalize in an accurate, timely manner, and summarize, post those transactions in the books and report in the form of account balances or footnotes in the financial statement. So the accounting information system makes sure that every single transaction, every single business event must be recorded and then reported. Monitoring of controls. Controls are eyes and ears, so that no person in the group can process a transaction completely without being seen and checked. So what we are trying to see, I gave you an example earlier that purchasing a laptop. So when you are purchasing a laptop, it went through 8 different people and you have to fill out 8 different forms until the computer was initially approved, until it got paid. So therefore 8 people are involved in it. So the chances of any kind of fraud in this scenario are slim to none. If only one person is requesting a computer, the same person is approving the request, and the same person is finding the vendor, and also the same person approving the payment, could create a lot of chances or opportunities for a fraud here. Okay. Control environment is the tone at the top. Tone at the top means the top management. How top management view these controls. Is the top management following these rules they have created? Is the top management observing that these rules are followed, or these top management are also reviewing at the end of the period whether these in control environment or these rules are working? Okay. They must behave honorably, means honestly, to set a good example, and it's corporate code of ethics. A corporate code of ethics modeled by top management but followed by everyone. Internal control procedures must be competent, reliable, and ethical personnel. So if you have these 3 things, competent people, reliable controls, and ethical personnel, then things should not, anything wrong should not happen. Assignment of responsibility. There should be a clear line of distinction between who's responsible for what. Separation of duties. And separating operations from accounting means the person who is working in the accounting, he's not working in operations. So for example, if I'm working in accounting, I have no business in the warehouse. A smart hiring practice simply means always hire qualified people. Separation of duties requires no one individual to assign too much responsibility. Comparison and compliance monitoring, operating budget and cash budgets, exceptional reporting and audit. What does it mean? You will study in accounting 2302 about budgets. Budgets is basically a desirable outcome for future. We want this thing. So we want to know this budget, the desirable outcome that we have set aside for say 2024, but in 2024 every month we are going to check whether we are meeting these goals and these targets. And if not, then exception reporting will provide us the information how much we are ahead of our goal or behind our goal or meeting our goals. So that's the idea about operating and cash budgets. Adequate records. Accounting records should be maintained so there is a record for to compare against. So for example, if you claim that on your balance sheet that you have 10 automobiles worth $20,000 each, so this is $200,000. It's a lot of money. So if an auditor comes to audit your automobiles, he should be able to physically see all 10 automobiles, and he should be able to see the paperwork that you have paid $20,000. He should be also able to review the maintenance record, how much you have spent in terms of it. So these are the things that helps you manage risk and also helps you verify the claims that you have made on your financial statements. Limited access, only person with custodial responsibility. What does it mean? An accounting person should not have the keys for the warehouse. Your cash should be always in lock and key. Lockbox system is a system where you receive checks. All right. Physical access controls, not everybody should have. Like for example, if I am working in a account receivable department, I should not have access to accounts payable department. If for some reason I want to meet, we should either meet at a conference room, which is outside the accounts payable and outside the account receivable. And if an inventory manager needs to have a dealing with accounts payable or accounts receivable, they also should not be able to just walk into accounts payable, accounts receivable. They should have a neutral place to meet. So this clearly defines that the access card the accounts payable manager or accounts payable employees have cannot go to the account receivable department or inventory department. In the same way, an inventory manager or inventory department employee cannot just walk in using their access card to the accounts payable department or accounts receivable department. Proper approvals. I gave you an example that an employee needs a computer. So he sent a request to his manager and a manager is approved or disapproved based on that. And then it gets to the credit approval, purchasing department, and all those people involved in it. Information technology or IT department helps improve the accuracy and speed of recording things. Sometimes we use electronic sensor and barcodes for safeguarding assets such as computer. Okay. Safeguard controls important documents in fireproof vaults for our accounting records. Alarm, security cameras. Loss prevention specialist is basically for inventory, that we want to make sure our inventory is utilized. Fidelity bonds on cashier means you are bonded, means if you make a mistake or if you commit a fraud or you ran away with a lot of money and we cannot find you, the fidelity bonds, the people who are standing behind the fidelity bonds would be able to help you recoup your losses. A mandatory vacation and job rotation. In certain places, the people who are handling cash required to take vacations and other people can work and see if they are doing their job or not. Physical controls, locked doors, safe, fences with guards. If you go to any company these days, you notice they have fences, they have guards, They required some kind of biometrics, for example, fingerprinting, or your retina, eye, sensor checking out whether you are who you are. E-commerce creates additional risk. Stolen credit card numbers, computer viruses, Trojan horses, phishing expeditions, all of those things that when you are working these days, every accounting system is online 24/7. These systems use internet, and these accounting systems also associated with office technology, for example, Microsoft Teams, Microsoft Outlook, Excel, Word. You accept, send and receive these documents all the times, but these documents could be corrupted, and you receive a document from someone you do not know. So all of those methods that we are talking about is important to tell you the document that you are receiving is a good document. We keep the security cameras to make sure nobody who is not supposed to there cannot come or leave. Control number: documents such as checks, sales invoices, and purchase orders should be pre-numbered so that any missing document is easy to spot. So sometimes we cancel checks, so we want to know what number of checks have been canceled. Every invoice has a number. We want to know which invoice was processed and which one not. The same thing applies to purchase orders. Develop plans and budgets. Budgets are a good way of looking at it. As so the next course that we're going to take, Accounting 2302, has two parts: cost and budget. In cost, we're going to learn how to calculate the cost of providing a service or producing a product. In budget, we're going to learn how much we want to sell, how many, for example, we want to sell items that we produce next year. Suppose a sales manager says we want to sell 1 million items. The production manager say, yes, very nice that you are willing to sell 1 million products or 1 million units of the product. However, our capacity is only 800,000. So that means we are short of 200,000. So the question is, are we going to sell 800,000 or are we going to sell 1 million? Are we going to increase our production capacity by 200,000, or are we going to outsource somebody else to make those extra 200,000 products for us? So these are the kind of questions we're going to talk about, and the budget helps us provide these questions, because every business has finite amount of resources and they want to know whether they want to invest that money in, say for example, outsourcing, or increase the capacity of the factory. Okay. Conduct internal audits. Internal audit function provides appraisal of company's internal control and their fund. So let me here define to you something about audit. So here is audit. There are two kinds of audit: external and internal. Okay. Internal auditor is as employee, and external audit is not an employee. Okay. Internal controls audits are internal audits and external audits. So audits are two types: internal, this is an employee. Their job is to provide or do internal audits 24/7. These external auditors usually come for 30 to 90-day period around end of the year. All right. So they are not an employee. They are an employee. They work there. They do not work for them. Okay. They are independent of business. Internal auditor, not independent. So these are the idea behind audits. Financial statement audit performed by external auditor, and PCAOB provides you all the rules that they're going to do. Okay, so when it comes to audit rules, So there are two kinds of companies, public and private. So public company use PCAOB rules for audit, and private company use auditing standard board rules. Okay. The public company cannot use ASB rules. So auditors cannot use ASB rules to audit public companies, but auditors can use PCAOB rules to audit private companies. And usually the companies who are thinking about going to public in the next 3 to 5 years, they usually go do the PCAOB audit under PCAOB rules rather than ASB rules. All right. So ASB is auditing standard board. There are many kinds of audit. One is called operational audit. It is evaluation of activities, systems, and internal controls to determine efficiency, effectiveness, and economy of these rules. Okay, or audit. Electronic devices that we use is sensors attached to inventory to reduce theft. E-commerce, you already know what e-commerce is. Other controls, we use fireproof wards, alarm, loss prevention specialist, fidelity, limitation. That is a very important part. Why it's important? Controls or internal controls can never be perfect. Can never be perfect or absolute. Okay. Why? Because if you make controls too hard, it reduces efficiency or productivity. Okay. So controls, you have to keep a balance between them. The controls should not be too perfect or too absolute or could not be too lax. So you have to go in between it. Another thing is that risk cannot be eliminated. It can only be managed. And again, no matter how good of a control you make, if there are 2 or more people involved in it, in committing or perpetrating a crime or fraud, they can bypass those controls, no matter how good a control is. So human error and collusion. Human error is a mistake, an error, and collusion is an intentional thing between 2 or more people, so it's a fraud. Here, collusion, 2 or more people working together, doing the management override, human limitation, fatigue, negligence cause these errors. Okay, and the benefits of internal control should always outweigh the cost. So because every company, it costs every company to create, to establish, to monitor these controls. If they spend too much money on it, it is not worth its while. Okay. Cost and benefit of internal controls cannot completely prevent fraud. Collusion is when 2 or more work to circumvent the internal controls and defraud a company. The stricter the controls, higher the cost. Okay. The next thing we're going to talk about, accounting for cash. The most important part you need to remember that cash include coins, currency, checks, money orders, checking accounts, and saving account. So if you are calculating the cash for any company, is not what is inside the checking account. There is another account here is called petty cash. So you have to make sure you add everything to calculate the cash. So coins, currency, checks, money orders, checking accounts, savings accounts, petty cash, everything is equal to cash the company has. Is reported as combined with cash equivalent consisting of such item as certificate of deposit, T-bills, and money market. When we say cash equivalents, which is basically simply means the cash equivalents can be converted into cash in 90 days. Anything that can be considered in 90 days is considered cash equivalent. Cash that is restricted, it must be reported separately. What is restricted cash? When we go to the chapter called bonds in future, you will study restricted cash. Restricted cash means it has been set aside for certain thing. There would be something you're going to study is called sinking fund. What sinking fund is sort of an insurance fund. So if something bad happens and company will not be able to pay the bondholders or their creditors, we use the sinking fund to pay those payments. Cash is so easily taken, concealed, or otherwise misappropriated. Most companies have developed elaborate internal control to safeguard their cash. Easily stolen, so make sure we're using cash register. Make sure extra cash is being dropped in the safes. So controls for cash involve mailroom or retail sales, area for receipt, treasurer for custody, controller for recording, and internal audit. You notice that treasurer is going to keep the cash and controller is recording. That is a definition of separation of duties. Okay. Cash receipt occur primarily when a business sells merchandise or services. It happens in almost every. A receipt of cash over the counter involves a point of sale terminal, cash register, that should have a camera on it. Many companies receive checks by mail for payments. Several controls are needed to cash receipt. So what are the monitoring cash? Cash on hand and important activities. These are the things that we need to do. Monitor the cash on hand and important. For example, some companies, they say if you have a cash more than $20, drop it in the safe. Cash on hand is how much cash you can keep at any given time. Maybe $20, maybe $30. These are the things. Managing receivable, managing inventory level, manage payable, and invest excess cash are the important duties that who does that? This is either treasurer or controller doing these things. Okay. Cash received by mail should be one person open it, second person recorded it, and the third person deposited it. Okay. Cash required is specific in control because easy to steal and convert. Point of sale terminal, we already have talked about it. Cash budget. This is something we're going to discuss in detail in Accounting 2302, how to prepare a cash budget. It's basically helps a company manage cash because you need, why we do the cash budget? The reason we do the cash budget because every month we have to make payroll, utilities, rent, interest payment, tax, any kind of tax payment. So you need cash to make all of these payments: payroll, utilities, rent, interest payment, tax payments. So all of this. So you basically create a tax. I'm going to show you a small T account. This is your cash. This is your beginning balance. And this is your desired end balance. How much cash collected. This is cash payment. And that will give you how much cash left. So beginning balance plus cash collected minus cash payment is the cash. Is this cash equals to desired balance? If it is not, if this cash is not, then you have to borrow the cash. This is just one example of doing the cash register. Okay, so this is all the cash that we have earlier discussed. This is how they're going to cash. Make sure you read about the petty cash. It's about usually $500, usually paid for smaller stuff like printing and pizza and coffee. The next thing we're going to talk about is bank account, because this bank account gives us new idea which is called bank reconciliation. Bank reconciliation gives us information, cash balance at any given time. how much cash we have in the bank at any given point. It provides record of payment, must be signed by authorized official, and payment supported by evidence. So these are companies make most payment by check or EFT. What is EFT? Is electronic fund transfer. Means you are sending from bank to bank, like you say your mortgage, sending from one bank to another. Controls over purchase and payment. We talked about purchasing goods, receiving goods, preparing check, and approval of payment. Evaluated receipt settlement compresses the payment approval process into single step by comparing the receiving report. This is done by a system, ERP system. Electronic data interchange, streamlined process, bypass paperwork document. Computers do that. Document used to control bank account include signature card, deposited checks, bank statement, and bank reconciliation. These are the definition of all those things. We're going to talk about bank reconciliation. I have already provided you a comprehensive example for bank reconciliation. Bank statement reports activity and how much money is coming in and how much money is going out, in and out, and what is the balance of these two. Okay. Electronic bank reconciliation. This is the example. Deposit in transit means you have deposit in the bank, but it hasn't hit the bank yet. Outstanding check simply means you have wrote the check, but it hasn't been cleared from the bank. Bank errors, if bank has making an error. Bank collection means bank is collecting on behalf of you. Electronic fund transfer, either you transferred it or you received. Service charges, like you pay for bank fees. Interest revenue, if you have any money in the savings account. NSF checks or hot checks, somebody give you a check, you deposit it in the bank is increase your balance based on that check, and then 2 weeks later they find out it's a hot check. They are notifying you through a bank statement that it was a cost of printed checks, bank error. So these are the errors. So when you prepare the bank side of the bank reconciliation, deposit in transit must be recorded on this side, and outstanding checks. So these deposits should be added, outstanding should be subtracted, and this could be a subtraction or addition, bank errors. Okay. And on the book side of the reconciliation, credit collections. So if your bank is collecting, it should be a if electronic transfer, it is a, you have received a payment, is a plus. If you make a payment, it would be a negative. Service charge is most likely negative. Interest revenue would be a plus. NSF check will be a subtraction. Cost of printed check should be a subtraction, and book error could be addition or could be subtraction, depending what kind of error. So again, in the last, what is fraud? And any act intentional. Any act that is intentional is punishable. It's a punishable crime. Intentional misrepresentation of facts is also a fraud. Persuading another party to act in a certain way is also fraud, and it causes injury or damage. So this is basically, so how many different types of fraud we have? Common type, committed by employees, theft of money or inventory, bribery, kickback schemes, overstate expensive reimbursement, committed financial reporting. So this committed by all employees. This one is only managers. False and misleading journal entries, and this to deceive investors and creditors. The fraud triangle basically talks about there are 3 things when it happens. When all of these 3 things are present, then that means that fraud will happen. Motive, which is like pressure, nearly all commit by under either financial or vice pressure. Rationalization, come up with a rationalization to overcome the feeling of guilt that everybody is doing it, or I will never get caught. Fraud only if there is a chance to get away with it, means if there is an opportunity. So either if we have motive, rationalization, and opportunity, that means we are going to have a fraud. So again, thank you for watching this lecture on chapter 7. Please let me know if you want to make any changes. Make sure after watching this lecture, you do watch the comprehensive example lecture where I have solved the bank reconciliation question for you. And again, I would really appreciate if you could provide me your feedback about any changes you want me to make in these videos. Thank you for watching this video. Bye.